What's up, everyone? We have a very, very important document that just got released today. This is the Federal Reserve Board's Monetary Policy Report. And I'm going to go over this just a little bit. I'll link this below if you want to take a look at it. I'm going to go over basically what they're saying. They're going to outline the events that happened the last couple years. And they're going to give future outlooks and give a little insight into what they're thinking and what we can expect moving forward. So we're going to start right here where it says supply chain bottlenecks in U.S. manufacturing and trade. Over the past year, global transportation and distribution networks have been overwhelmed, and manufacturers have struggled to find the materials and labor needed to meet demand for their products. Demand for goods has been notably boosted, as ongoing concerns about COVID-19 have led consumers and businesses to shift spending away from services such as travel in favor of goods, such as those related to increased time at home. While some distribution and production bottlenecks showed signs of improvement towards the end of last year, other bottlenecks are expected to remain for some time. The surge in demand for imports has strained shipping networks worldwide, and U.S. ports have been particularly congested. About 1/3 of all U.S. goods imports by value arrive via seaborne containers, and consistent with the strength in imports of consumer and capital goods in 2021, the number of containers processed at domestic ports last year was significantly higher than in any previous year. The combined ports of Los Angeles and Long Beach have faced substantial congestion, with the number of ships waiting for a berth recently reaching an all-time high. Elevated levels of port congestion in the United States and abroad have caused on-time arrivals of global shipping vessels to plunge and have resulted in dramatic increases in charter rates for container ships. Moreover, once goods arrive in port, major bottlenecks in U.S. trucking and rail transportation have further delayed their movement. Trucking cargo rates have risen sharply since mid-2020, and some measures are now more than 15% above the levels prevailing in 2019. Okay, this next part here talks about the federal fiscal actions provided a diminishing degree of support to economic activity. So in response to the pandemic, the federal government enacted a historic set of fiscal policies to ameliorate hardship caused by the viral outbreak and support the economic recovery. A lot of this is going to be repeat stuff what I've been telling you. Remember the 14 policies they created? That's what they're referring to. Policies such as stimulus checks, supplemental employment insurance, or unemployment insurance rather, and child tax credit payments have aided households. Grants and aid have supported state and local governments, and business support programs such as the Paycheck Protection Program have helped sustain firms. Although these temporary policies continue to support the level of GDP, they have begun to unwind and are now likely imposing a drag on GDP growth, as the effects on spending wane over time. In addition to pandemic support policies, the Infrastructure Investment and Jobs Act will gradually boost spending on infrastructure over the next 10 years, and is only partially offset by new revenues and other spending reductions. And then it goes on to say, while significantly raising the budget deficit and federal debt. Overall, the Congressional Budget Office estimates that fiscal policies enacted since the start of the pandemic, including the infrastructure bill, will increase the federal deficits by roughly $5.4 trillion by the end of fiscal year 2030, with the largest deficit effects in fiscal 2020 and in 2021. These policies, combined with the effects of automatic stabilizers, the reduction in tax receipts, and increase in transfers that occur as a consequence of depressed economic activity, caused the federal deficit to surge to 15% of nominal GDP in fiscal 2020 and remain elevated at 12.5% in fiscal 2021. But with fiscal support fading, the deficit is expected to fall sharply this year to a level closer to that observed in the years just before the pandemic. Referred back to those charts I was showing you when all of the indexes started to tank, except one. As a result of the unprecedented fiscal support over the past 2 years, federal debt held by the public jumped to around 100% of nominal GDP in 2020, the highest debt to GDP ratio since 1947, and remained at a similar level in 2021. Nevertheless, net interest outlays, primarily reflecting debt service payments, have remained relatively flat over the past 2 years due to historically low interest rates on government borrowing. Okay, this next section here talks about markets for treasury securities, mortgage-backed securities, and corporate and municipal bond functioned well. Markets for treasury securities and mortgage-backed securities functioned smoothly since July, even as some measures of liquidity conditions for Treasury securities deteriorated moderately, which reflected increased yield volatility, due in part to uncertainty about the path of monetary policy. Measures of market functioning in corporate and municipal bond markets indicated liquid and stable trading conditions. Bid-ask spreads for corporate bonds across credit ratings currently stand below pre-pandemic levels and near the bottom of their historical distributions, while short-term funding market conditions remain stable. Short-term funding markets continued to function smoothly. The effective federal funds rate and other overnight unsecured rates declined slightly relative to the interest rate on reserve balances since early July. Secured overnight rates remain stable, with the secured overnight financing rate steady at the offering rate on the overnight reverse repurchase agreement on RRP facility on most days since early July. Ample liquidity and limited supply of Treasury bills kept short-term interest rates low and led to increased usage of the on RRP facility. No shit. So this section here, developments related to financial stability. This discussion reviews vulnerabilities in the U.S. financial system. Ooh, that ought to be good. Let's see here. Prices of risky assets remained elevated because they leveraged themselves with it during SLR because of your policy. Jesus. Prices of risky assets remained elevated, supported in part by low interest rate environment and low term premiums on Treasury securities. One common measure of equity valuations, the ratio of equity prices to forecast earnings, remains high compared to historical values. Spreads on corporate bonds and leveraged loans continue to be low. Price indexes for a range of commercial real estate sectors are at or near historical highs, and vacancy rates have declined. Residential home prices have continued to rise, with nearly 80% of metropolitan statistical areas seeing double-digit annual growth rates during 2021. Non-financial sector leverage has broadly declined. The rapid growth of nominal gross domestic product has brought the ratio of nominal credit to nominal GDP, which measures the aggregate debt owed by the private non-financial sector relative to the size of the economy, down to near its pre-pandemic levels, and that's going to be in figure A, which is right here. Homeowner equity is high and mortgage delinquency and foreclosure rates are below their pre-pandemic levels, despite the end of the pandemic-related relief and forbearance programs. Because of the high corporate cash holdings, aggregate net non-financial business leverage sits at its lowest level since 2014. Fueled by strong earnings and low borrowing costs, most businesses saw a sharp increase in their ability to service their debt burdens, with the interest coverage ratio, or the ratio of earnings to interest expenses, for the median firm solidly above pre-pandemic levels and near historical highs. However, for firms and industries hit hardest by the pandemic, including airlines, they're telling you what to invest right here, including airlines, hotels, restaurants, leverage remains elevated and interest coverage ratios are lower. Vulnerabilities from financial sector leverage are well within their historical range. Risk-based capital ratios are at domestic bank holding companies reached a 20-year high during the first quarter of 2021. These capital ratios declined modestly over the rest of the year as banks increased their share repurchase and dividend payouts amid an improved economic outlook and the Federal Reserve's lifting off restrictions on capital distributions. Throughout 2021, robust economic growth and strong capital markets contributed to high bank profitability, which fosters resilience through greater loss absorption capacity and an ability to retain earnings to raise capital if needed. In contrast, leverage at certain non-bank financial institutions, including life insurers and hedge funds, has remained near historical highs. Data limitations and the complexity of hedge fund strategies can obscure the true nature of leverage in that sector. However, one common measure of hedge fund leverage, the ratio of gross national exposure to equity capital, is near its peak since data became available in 2012. Funding markets remained relatively stable. Domestic banks continue to maintain significant levels of high-quality liquid assets. The market for digital assets, including stablecoins, has grown rapidly. The market value of stablecoins exceeded $150 billion as of January 2022. And then we got, this is a big one, LIBOR transition. So the shift away from the widely used US dollar, LIBOR reference rate stepped up notably in recent months in line with regulatory guidance to end most new use of USD LIBOR by December 31st, 2021, and well ahead of the cessation of those rates on June 30th, 2023. The transition away from US LIBOR has largely been completed in floating rate debt markets, where nearly 90% of new issuance now references the Secured Overnight Financing Rate, or SOFR. In securitization markets, the government-sponsored enterprises had stopped accepting LIBOR adjustable rate mortgages, or ARMs, in 2020, are now accepting only SOFR ARMs and have tied all of their associated MBS issuance to SOFR. Interest rate swap markets saw increases in volumes for SOFR-based trades in the second half of 2021, and this pace accelerated rapidly in January, such that SOFR-based swaps trading now accounts for the majority of risk traded in this market, indicating widespread awareness and adoption of risk-free reference rates. Euro-dollar futures have lagged the swap market, although volumes for SOFR-based futures contracts are increasing there also. The transition in business lending has been slower, although recent data suggests that the use of USD LIBOR as a reference rate for business loans has fallen sharply since the start of the year, and that the pace of SOFR adoption is accelerating. We know the Treasury market had resilience because it came out of that close scare there with the default. Bank credit expanded and bank profitability remained strong because crime, international developments. This is where it's going to get interesting, and this is where I'll cut this off and I'll start on a new video going into the international developments.